what I'm solving for is an 8% return for our investors. I really want to see, and early on, I mean, I'd like to see that in year one if we can. Now, it's not always possible, and we like to do value add stuff, so sometimes it's going to be lower in year one, but I really want to see an 8% return for our investors. And that's not going interest only for 3 years. You know, we might do interest only for the first year, but I'd like to be paying principal in the year two and still returning 8% for our investors.
Welcome to Deal Flow with me, 𝐬𝐻𝐫𝐞𝐭, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. I talk with industry insiders on a week-to-week basis on everything real estate and prop tech. Today, we are excited to welcome Lee Yoder, founder and CEO of Threefold Real Estate Investing. Lee has made a significant transition from being a physical therapist to a standout figure in the real estate investment space, specializing in achieving passive cash flow and growing wealth through multifamily investments for his clients and stakeholders. At Threefold Real Estate Investing, Lee focuses on helping investors maximize the returns through strategic multifamily property investments. Lee, thank you for joining us today.
Michael, thanks for having me. Happy to be here.
Awesome. Well, I gave you a little bit of an intro, but I would love to hear directly from you. So just give me a little bit about your background, where you started, kind of what you're focused on today, and then we'll get into it.
Yeah, sure. So graduated with a doctorate in physical therapy in 2012. Did that for a little bit. Came on with a company here in Cincinnati, Ohio, where I'm located. It was a startup company. It was in healthcare staffing. So I came on as a physical therapist, but pretty quickly came into the office, was doing no physical therapy anymore. This is just a few years into graduating. And I was really helping build out a division for this startup company. And I was loving that work, Michael, not missing physical therapy at all. Then I decided just kind of that, not so much like getting burnout, but my wife and I were starting our family at the time, and just the climbing the corporate ladder, just some of that stereotypical stuff that and this was pre-COVID. So it was be in the office as much as possible. And it just felt like this might not be what I want to do long-term. But man, I loved feeling like I was building this division within the company. And so I was like, man, I cannot go back to being a physical therapist. I found more what I love doing. And I didn't really know exactly what that was yet. So just started reading some of the books that a lot of people read, the Rich Dad, Poor Dad, going down that rabbit hole, and really starting to feel like, man, there's this whole other world out there that I think fits me better than going back to being a physical therapist, which just felt unacceptable once I kind of found what I like to do. So kind of got this idea that I would leave the corporate world, go back to being a physical therapist, and specifically doing home health physical therapy, where I'm driving around to older people's homes, doing therapy with them in their house, but doing real estate on the side. So left at the end of 2016, that corporate job, took a pretty big pay cut, but with this idea that I was going to do real estate as a side hustle. 2017, we flipped a house. 2018, we flipped a duplex. 2019, got a few small multifamilies. COVID happened. The Fed went wild. Government went wild. Real estate took off. So I was able to sell my whole portfolio that I built up, which was just 34 units, just this 3 little multifamily properties. But that gave my wife and I enough to stock away in our savings. And I said, this is my runway. This is my cushion. We're going to go all in. So I quit my W-2. My wife had actually already quit her W-2. Our kids were a little bit older by this time. She wanted to homeschool our kids. She was an RN. It was just PRN at the time, but quit that. So we had no W-2s at the end of 2020. So I always say 2020, the year of COVID, was crazy for everybody. We made it extra crazy by quitting our W-2. So I've been all in on real estate ever since then, at the end of 2020. And we started syndicating. So it just means we started doing bigger properties and more investors and more paperwork in 2021, and been doing that ever since. And I love it. I want to do it for the rest of my career. Finally found what I want to do when I grew up. And so we're just trying to do more and more of that.
Awesome. Well, thanks. So that was a great rundown that you're able to give me pretty quickly. So yeah. I gleaned onto a few different things. I think there's a lot of people that can resonate with your story of,
sure.
Spending a lot of time getting to the start of their career only to find that maybe that wasn't the career for them. And so, and then, quit, a lot of people have trouble, pulling that cord, right? leaving their W-2. So maybe you could just talk, go back in time to that period where you were talking about, you started with a single family house and a duplex, and just maybe spend a little bit more time in that period where you kind of got your feet wet, and then you got the confidence to then move on from the W-2. And then, because I think that'll help a lot of people here.
Yeah. It was hard for me, Michael. It was really hard for my wife. She's much less risk adverse and was not, all in on real estate nearly as early as I was. But yeah, that flip was kind of, it felt like low risk to me, certainly. Not as much my wife, but she bought into it. But basically, Michael, we could have afforded that mortgage along with the mortgage on the house we lived in. So kind of worst case scenario. I think people, my wife's always like, well, I'm worst case scenario. I'm like, well, yeah, but I think your worst case scenario is wrong. Like, it's okay to think worst case scenario, but actually the worst case scenario is that we're paying a mortgage on 2 houses. And so we're just paying off 2 houses. Like, that's not that bad. Cause again, I still had my full-time job and it was enough. And that's one thing we really did, Michael, that I think a lot of people don't do. Like, we really lived below our means. So we had cash and we had margin. Like we could take on this other mortgage. And a lot of people, it's like, gosh, we can barely afford the mortgage and the car payments and all the other payments and all the subscriptions we have and everything else. And that was not us. We had margin, so we could afford another mortgage. So that was worst case scenario. And like, that's not good. That's not winning at real estate, but paying off 2 mortgages, I mean, there's worse things, right? If we still own that house today, it'd be worth way, way more than we sold it for when we flipped it. Right. So like, real estate works. So it was like, that just helped. Like, if you can really go, all right, what's really the worst case scenario here? And even jumping all in when we did, we had enough in our savings to live for a few years. So worst case scenario is a few years from now, I've been able to do nothing in real estate. That seemed unlikely, but okay. And I'm in healthcare. My wife's in healthcare. Healthcare jobs aren't going anywhere. I mean, we could be in the middle of a recession. You can still go get a job as a nurse or a physical therapist. So it was like, that's worst case scenario. We're right back where we were. So that helped us kind of get over the hump. And, I haven't had to go back to work as a physical therapist yet. My wife's still at home homeschooling the kids. So it's worked out so far.
Sure. Yeah. I think 2 things in there that were interesting, you living below your means, having extra margin, having a margin of safety, having that runway, and then that worst case scenario analysis. It's really important that I think to kind of look at that analysis and just understand, okay, well, if things don't go your way, what does that look like? And in your case, right, the worst case scenario is you'd have to get a job again, right?
Yeah.
So
right back where we started.
Not horrible. Yep. You started with a great foundation, a good education, a good career as a professional. And so you could always slip back into that if necessary. Right. And thankfully, not necessary and hopefully won't be necessary, but I think it can take a little pressure off, especially when you're dealing with, you have a spouse, you got to get everyone's got to be on board, right? Ultimately,
right. Yes.
For the vision of what you're going to do.
Yeah.
So switching to, I guess, so now it's 2021, you've now left your job, you sold, I guess, maybe speak a little bit to, you sold that portfolio of 34 units. There was a little bit of it seemed like you had done a single family, you had done a duplex, and then, just a little bit further down the road, you had 34 units. Where was that? I think I missed that part of the story. Yep. How did you get from 3 to 34? And I think, someone, I didn't coin this phrase, but that law of the first deal, right? Is you get that first deal done and then,
Yes.
you know a lot and you can kind of just keep going and it takes a lot of the pressure off once you break the seal on that first deal. So, and it seems like that was the case for you, right? You went from, in 3 years, 30, 40 units and then full time. So yeah, tell me a little bit about how you went from, 2 or 3 to 34 and then that sale process during COVID.
Yeah. Yeah, I did kind of gloss over that just for the sake of time, but yeah, happy to talk about it because that was a huge jump for us. We did again a flip in 2017, a duplex in 2018. We sold both of those, so we kind of flipped both those. So then in 2019, and I had joined the Real Estate Investors Association in Cincinnati, the RIA, and they had a apartment focus group. And there was a guy there that had bought just a couple apartments. He bought like a 25 unit and a 40 unit. So not like, big time expert, but he had done it a couple of times. He, had gone through the process and he was teaching the rest of us to underwrite. And so that was invaluable. And he was kind of my first mentor and I brought him as a partner in on the first deal. And the first deal I found on LoopNet, where people say deals go to die. And so if you're getting started, for me, I was like, well, so probably nobody else wants those deals. So those are probably the ones I can get. So that's where I found my actually 2 of our first 3. So in like August of 2019, I found this 16 unit, just 20 minutes up the road from where I live. It was an old school building that someone turned into a nursing home, and then someone turned into apartments. It was dilapidated. I mean, just a rough property, been sitting for a long time. And so I lowballed an offer and got it. And again, that mentor helped me get into that. And I really saw the law of the first deal there, Michael. And I'll tell you another big piece of that, because my mentor, Mark, was huge, gave me a lot of confidence and helped me just learn the ropes that first time through. But also in that case, I partnered with a third-party property manager, and that was huge as well, because taking on, yes, we managed the duplex ourselves, and it was like a little bit scary. We didn't enjoy it. Taking on 16 units just seemed so overwhelming. And like, how the heck are we going to manage 16 units and get 16 people to pay rent and handle maintenance requests for 16 people? Once we found the property management partner who was managing 1,000 units in that city, which is not a lot, but 16 units is 1.6% of their portfolio. So for them, it's no big deal. That was like such a breath of fresh air, such a relief to like, okay, we don't have to worry about collecting rent. We don't have to worry about evicting people. We don't have to worry about answering maintenance requests, because they're going to do all that. That was huge and helped us really get over that hump. But that law of the first deal is so true, Michael. Like once we did that, we were ready to do another one, because we knew how it worked. We knew how to put in an offer. We knew how to sign a contract. We knew how to do an inspection. I had the property management company ready to go. So as soon as we found another one, it was like, I can just run this play again. We just ran this play. We'll run it again. And it happened like that because actually the day we were closing on that 16 unit, I'll never forget it, because the day we closed, we went to dinner with my wife and her parents to celebrate. And I asked my wife at that dinner if I could put another property under or make another offer on another property. And she couldn't believe I was asking her that. She's like, you will not let me rest. Like, I just got comfortable with this 16 unit, but we put an offer in on an 8 unit and ended up getting in. It's probably, I remind her of this all the time. I'll probably never do a deal that good. This 8 unit was incredible, just good timing and everything. So yeah, the day we were closing on 16, got an 8 unit under contract. And then it was just like a month and a half later, we got a 10 unit under contract. So that was all fall, winter of 2019. And again, I'm working full time. So once we got those, like, it was harder to find stuff. And then that was kind of enough. So we had third-party management, but I did a lot on the kind of like the construction projects, kind of running as like the GC on those. So those were all heavy value adds. The 10 unit was like 40% occupied when we took over. So heavy value adds, we did a lot of work on those. And so we were able to really turn that portfolio around. And, getting toward the end of the fall of 2020, the cash flow was pretty good. We just did joint ventures on those. So 50-50 with a kind of a money partner, just family and friends. And they would do a little bit of the work, but basically it was all us, and they would bring all the capital and we'd split it 50-50. So, we were making, I don't know, if we would have got that whole portfolio stabilized, we were making like 30 to 40 grand a year. And that was like maybe half of what, like the bare minimum we needed to replace my income, which is what I told my wife I was going to do. But it was just taking too long, and I didn't want to like wait another year and a half to do that again. And then I started looking at what stuff was selling for, which, just crazy. By 2020, by the end of 2020, like, people freaked out at the beginning when COVID hit, but then it went nuts, right? So by the end of 2020, I'm like, my gosh, we have so much equity in these already. Why wait, to double the portfolio before I leave? Like, why not just sell, take all the equity, put it in our savings account, give us that cushion. So that's the part of the story that I skipped. It is an important part. That was a huge mountain to climb to go up to get that 16 unit. And it was with a mentor and a property management partner to do that. But man, you're right with the law of the first deal. Once we did it, I was like, that's not, that scary anymore. Now it's just like riding a bike. Riding a bike for the first time is incredibly difficult. The second you get it, it's like you can jump back on and do it again. It's not that easy the second time, but it's a little bit similar. And so we just did it a couple more times.
Great. Yeah. And just a shout out. The law of the first deal is something I heard from Michael Blanc.
Yeah, me too.
Who's in the education space. So
yeah,
shout out to Michael Blanc for anyone who's, getting started in the space and is looking for good content, good education. Right. So you went through that, you built that portfolio up very quickly. Sounds like you got great experience on the asset management and construction side, going through those deals because they were deep value add. You were third party managing it. And then you go ahead and you sell that, you leave your job, you've got your cushion. And now it's time to, figure out the next step and figure out how you're going to, build your career from there. So tell us a little bit about after that. So we're going into 2021. What does that look like?
All through 2020, once I had that portfolio, I mean, I was already all in on real estate, but with this portfolio, I was all in on multifamily, but also all in on going bigger. I just knew I wanted to scale. I mean, everything I'm listening to, Michael Blanc was a great podcast. I used to listen to all the time, got so much from that. But the guys and girls that I really identified with on there, and I mean, most of you that come on that podcast are doing the bigger apartments. And that's just, I knew that's what I wanted to do. I felt like with that portfolio, Michael, I felt like I could have went two different routes. And they're both great routes, but I think you got to figure out which one's for you. And one is to kind of do more of the same, to buy smaller 8, 10, 20 units. I mean, maybe even some duplexes, some quads in kind of a local area, and build a portfolio and maybe get to the point where you're managing it yourself, and you can kind of just do it with a few partners. And you can do that. And I mean, I've seen people do that and they're making, a couple $100,000 a year, a few $100,000 a year. You can do really well, but you're at some point kind of limited on your scale, and you're really not building a big business. You're just kind of building, you're kind of going to be a solopreneur, maybe a couple of people, but you're just going to build kind of maybe a small company and a small portfolio. Again, that's fine. For some people, that's kind of all they want. I really wanted to buy bigger properties, build a big business, have, a company and partners and people working with us and buying really big properties and build a big business. So I didn't want to keep getting more of the small stuff. I wanted to get the bigger stuff. So another shout out would be to Joe Fairless. I don't know if you know him with Best Ever. So he wrote a book called The Best Ever Syndication book. And that's kind of a roadmap for how to get into syndication. So I just felt like, well, I think that's what I want to do because I want to buy bigger properties. So read his book and just kind of started doing a lot of things. So I did a podcast for, I think 3.5 years. And I stopped doing it like a year and a half ago. But I started that. I think I started in 2020 and just kind of doing a lot of those things, like just doing what Joe said he did, doing those things. And got a website, started figuring out, an investor portal and stuff like that, just kind of putting all that together in 2020, and going to meetups and talking to people and getting ready to raise capital. So we were doing all those things in 2020, so that really it was actually at the end of 2020, very beginning of 2021, we had our first syndication under contract.
Awesome. All right, cool. Yeah, that was great. Yeah, I definitely know Joe. I'm here based in Boulder, Colorado, and I've been to his best ever conference when he's done it here in Denver a bunch of years ago. And
yep.
And I actually have met business partners, money partners, operating partners, all sorts of great people through that. And used to listen to that daily podcast back in the beginning of my career. So were you doing a daily podcast as well? Did you,
no.
Or did you do weekly?
Oh my gosh,
okay,
no.
All right.
Once a week, plenty for me.
Oh, there you go. Yeah. Quite a production to try to do it every day. But an operational feat. So I think that's and a dedication, right? So
for sure,
that Joe has to the craft. So now we're in 2021, you got everything set up, and you said you got your first kind of syndication deal under contract. Tell me a little bit about that deal and, what happened with it, how'd it go, the raising the money, the due diligence. Obviously it's a different ball game when you're writing the check or you're dealing with a couple folks that well versus, going wider and trying to raise money and having to bring in all the documentation and the cap structure and the various, 506C, B, whatever you guys were doing. So tell us about all of that and, how that went for you.
Yeah, it was, we got that through a friend of mine and he had just become a friend just in the multifamily, investing space. Forget how I first found him, maybe we found each other on Bigger Pockets or something like that. But he's a local guy. I kind of live between Cincinnati and Dayton, Ohio, and he was up in Dayton, and he brought this deal to me. It was, he buys a lot of stuff, but he buys very distressed stuff and does very well with it. And so this property wasn't great, but wasn't distressed enough for him. So he brought it to me, and it was kind of a perfect step, Michael, because it was 45 units, which the biggest we had done up to that point was that 16 unit. But it was actually 2 8 units and a 29 unit. So, and it was fairly cheap. It was on the west side of Dayton, which I wouldn't buy over there again. That's the worst part of Dayton, Ohio. But yeah, got it pretty cheap. So we just had to raise $550,000, which the most we'd ever raised before that was like 130. So still a huge step up for us. But we're able to do that with just 7 investors. So, not a giant step as far as the capital raise, but felt like it at the time. But just this guy brought this to us. It was off market and it was a great deal. And, with being 2 8 units and a 29, just felt like, this is the right kind of next step. and going from, raising 130 on a deal to 550, kind of felt like the right next step. So, yeah, it was difficult. It was still tough to find those people because, yeah, we did go outside of family and friends. We had a couple guys that were part of the local RIA that I mentioned before that I joined, a couple guys from that RIA that had gotten to know me, invested with us. So it's kind of the first time feeling like we're taking outside capital in a way, beyond our close network of people. But yeah, we're able to get that done. And we worked with that same property management company. And no, actually we didn't. We actually, before we closed that, we switched to a different property management company, another one in Dayton. And it was a good move, and they ended up being a good partner to us, and they managed several properties for us. But yeah, overall it went pretty well. And we actually sold that about a little over a year ago, and did very well in that exit, held it for about 2.5 years.
Okay, great. So instead of going, step by step, let's bring it to today.
Sure.
Maybe tell us a little bit about where your company is today. Are you a buyer in today's market? Kind of, tell us a little bit about, right after this period of time that you're describing, the Fed increased interest rates, and it's definitely, changed the game for a lot of folks as it relates to buying deals, managing deals, dealing with all the things that happen when interest rates change. So, to tell us a little bit about where you are today and kind of what you're focused on as it relates to acquisitions, location, that sort of thing.
Yeah, good question. So yeah, that one that I was talking about, we closed in February of 2021, and you're right, that was a very different time. So we closed a couple more that year and got another one the next May. The one that we got in May of 2022, a week before closing, the bank raised our interest rate a half percent on us, and that sucked, and also made us put like $180,000 in an escrow account for a year. So we got to see firsthand, like, wow, okay, banks are tightening up, everything's changed, the game's changed, right? Still got a good interest rate back then, compared to what we can get today. So we had 283 units at that point by May of 2022. But then we did not do another deal for a year, actually over a year. And so by like May of 2023, we finally did another deal, and we did 2 in 2023, but both of those were seller finance, because again, with the interest rates as high as they were and prices still high. And then, by 2023, rents are stalling out. Like, you're not able to tell yourself this big growth story that you could in 2021 and kind of the beginning of 2022, things were stalling out. So much harder to get deals done. So we got a couple done where the sellers were willing to seller finance it for us at 5% interest, which was a much better interest rate we could get from a lender. So we made a couple work that way. And like I said, we did sell a couple last year, both 1031 buyers. So they had kind of extra incentive to pay us a good price on those. And then today, then we went another year after we closed those in like May and October of 2023. We went another year, which brings us up to today. We do have a couple under contract today, but it's been a year since we've closed, and I'm just here lately, finally seeing some things where I'm like, that's a good price. Okay, that's more like what we're looking for. And then of course rates have come down significantly over the past 6 months, and it looks like probably that the trend is in that direction, or at least not going up, but probably trending down. So we've been able to make things work a little bit better, but it's been really tough. I mean, yeah, really since March, the Fed started raising interest rates in March of 2022, and up until obviously September 2024, they were raising and then holding, and it's been tough. And interest rates mean a lot in commercial real estate, as you know, Michael. And like I said, the other part of that is like rents aren't growing. I mean, it's not this big growth story. So if you're underwriting, for me, I'm pretty conservative on what I'm expecting to see out of rent growth over the next year or two. And I want to be prepared for seeing like no rent growth over the next year. And so when you're doing that, you're not being very aggressive on price. So it's hard to win deals. And I always say, with interest rates high, the bank is taking a lot more of the profit. When the bank wants to take more, leaves less for the rest of us. So it just makes deals less appealing.
Yeah. No, so you touched on a couple of things as it relates to, I think, underwriting, and you talked about seller financing, which is interesting. But before we get into that, let's talk a little about underwriting. You started out doing local deals, relatively small. Sounds like you continue to do bigger and bigger deals as time went on. Maybe, if you were talking to a broker and they asked you, what are you looking for today? What's that 30-second, 1 minute thing that you say to brokers about the size of deal you're looking for, cap rates, anything you want to talk about, location, quality, all that sort of stuff.
Yeah, I think I frustrate brokers when they ask me that, because they just kind of want these simple numbers, and those numbers that they're looking for, they can kind of manipulate things to give you that number. If you were to say like, well, man, I'd really love to buy at a 7% cap rate because, I'm going to get 6.5% interest and I want positive leverage, right? So I want a cap rate that's higher, a going in cap rate that's higher than the interest rate that I'm going to get on the loan. Well, there's so many brokers would be like, yeah, this deal is a 7% cap rate, but when I underwrite it, it's not, so, but really for us, Michael, when I'm underwriting, truly what I'm solving for is an 8% return for our investors. I really want to see, and early on, I mean, I'd like to see that in year one if we can. Now, it's not always possible, and we like to do value add stuff. So sometimes it's going to be lower in year one, but I really want to see an 8% return for investors. And that's not going interest only for 3 years. We might do interest only for the first year, but I'd like to be paying principal in the year two and still returning 8% for our investors. And so we're cash flow buyers, and that's what that means. And I want an 8% return for our investors. So the deal doesn't have to do more than 8%. I don't need a return for myself and my team in year two. And so if we do an 8% preferred return. So if the investors are getting all of it in year two, that's fine. But still, a lot of deals are really hard to truly cash flow in year two, 8%, if you're paying principal and interest. And so that's kind of the mark. And so that's what my underwriting has to spit out. And, if you're buying it negative leverage, that's going to be really hard to do. And if you're not predicting a bunch of rent growth. So again, you look at the broker's model and it might be like, yeah, you will get 8% in year two. Oh yeah. Cause you think I'm going to increase rents by 15% on the property from year one to year two. Well, I don't see that happening, so I'll tell them, things like positive leverage and yeah, I want to buy at a 7 cap or something like that. And I might have an idea. Another thing I like to look at, Michael, that I wouldn't necessarily tell a broker because I feel like it's not a metric they use, but I still think, and this is not true, I don't think for like A class stuff, but we just do C class stuff. And I feel like it still works on C class stuff where the 1% rule that a lot of guys use on single family is so simple, but they would just say, just start out. If you want to buy $100,000 house, you better be able to rent it for $1,000 a month, right? Like if you can kind of hit those numbers. And I really think that holds true for a lot of apartment buildings. If you're going to buy at $100,000 a unit, you should be able to rent it for $1,000 a month or more. And there's so many deals I see that don't hit that, that are negative leverage. And I know kind of before I even underwrite it, that's not going to underwrite well. And, sometimes I'll underwrite those and it's like, yeah, that's a really poor deal. I'd have to pay a lot less for that. So that's kind of a long answer. But that's kind of how I approach it. And so when brokers are asking for like, they just kind of want that quick, yeah, what cap rate are you buying at? What are you expecting to do with that? What do you want your, yield on cost to be, or, your operating cap rate in year three or whatever, it's like, I don't even want to give you that. Just like you tell me the numbers, I'm going to put in my underwriting and tell you, where I'm at on it.
Sure. Yeah. And so to get to 8% cash on cash with paying P&I in year two, I imagine you're doing deals still under 100 units to do that, or are you looking at deals that are larger? Just from what we're seeing, it's that's maybe achievable in the 75 units and under space, but
good point, Michael.
Otherwise.
Yeah, it's funny. We've stayed just under 100 units, so we've done 2 96 unit deals and 1 95 unit deal. So yeah, you hit the nail on the head. Now the ones we have under contract today are bigger, so I'm excited and I feel like, maybe something's broken loose. But the other thing, Michael, is that we go very tertiary. So, I said I live in Cincinnati. I actually don't. I live north of Cincinnati, but that's what people can identify with. But if I'm talking just kind of off the cuff with people, I'll say we own 1 in Cincinnati and 2 in Dayton. But the 1 in Cincinnati is actually outside the outer belt of Cincinnati. So you wouldn't even call it Cincinnati, and it's not in Hamilton County, which is Cincinnati. It's in a county outside of that. So, but that's how we got a great deal on it because it's 95 units and it's outside the outer belt. So I'll go further out to buy a better deal. And yeah, right. And the 2 we own in Dayton, they are Montgomery County, which is Dayton, but like kind of top corners of Dayton. And then we bought one. The one we bought, one of the ones we bought last year was way up like an hour north of Dayton, which a town called Lima that nobody's ever heard of. It's a smaller town, but great deal. And the town's not growing, but like it's cash flow. I mean, we got a great deal on it, better than the 1% rule and things like that. So, yeah, you're absolutely right. We've been under 100 units up to this point, and very tertiary in order to make those numbers work.
Sure. And when you say tertiary, I assume that also means like relatively low population.
Yep.
Rents are relatively low, limited population growth, but stable kind of market. And so when you acquire those properties, are you expecting to hold those for a long time? You talked about, I guess that's one question. And the second thing you said is, you want to get to that 8% cash return by year 2. Do you target a IRR or some kind of additional metric for your investors? I'm not saying it's a good thing to do because you're speculating on exits and stuff like that, but investors are expecting us to say something, right?
Yeah.
Say something about your exit, how long you're going to hold it, when am I going to have my money back, what's that multiple going to look like? Beyond cash yield in year 2, which I think is a great threshold for underwriting. What are you trying to deliver to investors beyond that?
Yeah, we do that, Michael. And up to this point, we've really always gotten like regional bank financing, and we get a 5-year term. So it's just kind of nice and easy to say, hey, here's the 5-year plan. And you're right. Like, I have no idea what's going to happen in 5 years. But hey, guys, we kind of want to average an 8% return for you over 5 years. So you've made 40%. And then when we sell, we want to make another 40%. That's just kind of real cut and dry, real easy. And I'll say, like, we do 506B. So I'm not selling right now. We can only invest. We can only bring in people that have an existing relationship with us. So I'm not offering anything to anybody out there. You've got to call us and have a relationship with us first. But that's just kind of in general. So Michael, 80% divided by 5 is 16%. So an average return of 16%. Of course, but half of that's on the back end on the sale. IRR is going to be somewhere around, 15, 16, 17%, if you do a return like that. And yeah, so that's just kind of what we tell our investors. And then I will tell Michael, sometimes it is a longer hold. Sometimes I'll tell them, look, guys, plan B is actually to refinance this in year 4 or 5 and hold for another 5. Or I'll say, hey, plan A is to sell. And so I want them to kind of know, but I'll say, look, we don't know what's going to happen. Up to this point, we've not held anything more than, we're not even up to 3 years on one. The market's been good and we've sold much sooner and done much better than we thought. But that's just where the market's been up to this point. That's obviously changed dramatically. So, we think we're going to be, holding stuff a little bit longer, but we'll see. But yeah, we still give them a 5-year plan and kind of give them some metrics that, hey guys, if we hold for 5 and sell, this is what it looks like. Cause you're right. That's what allows you to tell them what their full return is if you sell and we may. So yeah, we'll give them that 5-year plan.
Yeah. And also just so they have an expectation, right? Of, they're going to give you money. When are they going to get it back? Right.
Yep.
And how much, hopefully. Right. So you've now had to, raise money from, I imagine, more than 2 outside investors with the additional deals that you had to do.
Yep.
Maybe could you speak a little bit to how did you do that? Was that referral based? Did you have to go out and network? How did you build that investor base to the level where you're able to take down these 100-unit deals and raise presumably, millions of dollars at a time at this point? Yeah.
It's crazy to think about, Michael. I still can't believe these numbers, but we have raised from 89 investors over 8.3 million. Just seems wild. And that's, it's kind of me and my wife doing that. I did have a partner that worked with on first few, but he didn't really help raise much. But yeah, just kind of wild. It's a lot of organic growth, a lot of friends and family that talk to other friends and family that talk to other friends and family, things like that. It's the Real Estate Investors Association in Cincinnati has been big. Going on other people. I did a podcast. I will tell you, Michael, for me, and I did not put really much time and I didn't put any money into it. So it's not like I tried that hard. Maybe I should have done more. I didn't really raise capital from my podcast. I have gained investors from going on other podcasts. So going to other podcasts, going to some meetups. I try to speak at events when I can. I've gotten a few investors from here and there. So we do have investors from, probably like 20 different states, which again is kind of wild, but the bulk of our investors are here in Southwest Ohio. And it's family, friends, other people in the real estate industry in this area that find out about us and they're interested in real estate and in this area and things like that. So it's kind of how we've been able to do it over the past few years.
Sure. So good results leads to referrals. And then getting out there in the digital space and then getting belly to belly in the local events, in the local communities is kind of how you've done it. So, I think someone told me recently, there's not one way to get 100 leads. There's just 100 ways to get one lead, each, so you kind of a little bit of this, a little bit of that. You never know when the next thing is going to come from where. So, and so now you've got a couple deals under contract. So you're going to be going back into, hopefully if these deals, get to the next stage, you're going to be in money raising mode again. Tell me about before, rather than getting into the money raising more, I think we talked a little about that. Tell me a little bit about operating these assets. Now, it sounds like most of these deals, like you said, are local to you. So you're able to, get to them if you need to, but you also have third-party management. And so it sounds like you're relatively, well involved or heavily involved in the operations of the properties. Tell me about how you manage that. How do you manage the manager? How do you deal with the renovation plans or the business plan execution? Just kind of tell me a little bit more about that experience for you so far.
Yeah, that's you outlined it well. I mean, we're close. We like to be very hands-on. We're at the properties a lot, especially early on. It's really within the first year that we do a ton of work, a lot of repositioning of the property so that we can set it up to see that growth. And we kind of put it on this trajectory of, putting a bunch of money in the property, make the property look a lot different, so that we can justify the rent raises we're giving the current residents and the new rent we're bringing new residents in at, and we're renovating a ton of units. And so we're very involved and hands-on for that first year into the second year. And then, and then it's kind of more managing the manager. And we had a good property management company that we were working with. One of the best, if not the best here in Cincinnati, but we actually did decide a little over a year ago, Michael, to bring management in-house. And so now we manage our own. I just got to the point, like I said, going all the way back to that 16 unit, we were like, we have no idea what we're doing. How could we ever manage this property? There's no way we can do this. And we found third party that was like, oh my gosh, they manage 1,000 units. They know exactly what they're doing. Let's hand it to them. Well, that was 2019. So by 2023, 4 years later, we felt like we did know a lot about property management. We hadn't done it ourselves before, but I mean, just a little bit, but we were right up against it. And then, the other thing I kept looking at, I was just getting frustrated because we had, close to 100 units at most of ours, the property manager would put or the property management company would put a property manager on site and a maintenance guy on site. And, when they would do that, the property would do really well. And we were really happy. But then the property management company would start using that property manager at another property and that maintenance guy at another property. And we would see our performance go down. And then we'd find out what was going on. And I'd be like, why are you doing that? Well, they're doing that because if they can stretch their staff like any business, they're going to make more money. Well, we started feeling like, man, if she and he were our employees, this would be a lot better. And they're going to do the work. Now we got to provide the back end support and all that. I mean, it's a lot. But we just felt like, man, I think we can pull this off. So we actually got one of the properties we bought in 2023 was a 64 unit. And it was actually a 48 unit and a 16 unit that were pretty close together. And the property management company we were working with actually kind of didn't want it. And there was a guy on site. It was actually the seller's brother. This normally never works out. But the seller's brother was living at the 48 unit and he was managing the property. But the more we dug in, we just were like, this guy's doing an awesome job. So it just felt like maybe God was opening some doors because the property management company that we were working with didn't want it. We already had the guy and we're like, again, going back to that thought, like, well, if he's doing it and the seller, like he's in Florida half the year, how's he managing this? Like if he can do it, why can't we do this? So we decided to try it on that property. So, we sign up for Appfolio and get that all set up and get this guy and get all the residents online on that Appfolio. And we're setting up the accounting stuff. And it was a really heavy lift, but that guy is still one of our best employees. Hard to believe that the seller's brother lives on site is as awesome as he is, but he is. So that went well. And once it kind of back to the law of the first deal, like once you build it, I mean, once we went to buy another 96 units, like, well, I mean, we got it all now. Like, why would we not use it? Like, this is kind of a waste if we don't. So we did the next one. And then since we sold two, we only had two left that the third party management company was managing. So in December and then January, we brought those two in. And so then we were managing all of them ourselves. So going forward, that's the plan, is to keep managing them ourselves. So, yeah, that was a long setup to answer your question. So now we're very hands-on, Michael. We just basically have a property manager and a maintenance guy at each one. Now, the reason a lot of people want to buy more than 100 units and like Lee, you're probably, if you know, you're doing less than 100 is because they run kind of heavy with a maintenance guy and a property manager, especially more C class, right? Like if they were 96 units, but A class, that'd be a totally different story. They'd be renting for 2,000 instead of 1,000. But they run kind of heavy. So, but because we're doing ourselves, we can still do it so much cheaper than the third party management company can. And so it's been a good experience. I'm glad we did it. And, and it's one of those things, once you build it, now you've got it, and now scale helps. So the idea is, the more we can kind of buy in this area, we'll be able to do better. And I've got a good partner in that. And he's not like an equity partner, but a guy that works with me that really kind of runs that side, and he does a great job. So that was my main thing. Like, I don't want to be a property manager. I don't want to be the CEO of a property management company. So I kind of have another guy that does that, and I'm able to focus on, more of the front end, bringing the new ones in. So yeah, it was a lot, but it's going well. Glad we did it.
Yeah. So it sounds like you've got your site teams set up, and then you have sort of like a regional that sits on top of that, or maybe someone a little bit more than a regional. That
kind of both, kind of a regional and then somebody over her. Yeah.
Okay. All right. And then you got a controller that handles your books, so you outsource that, or how do you handle that?
Yeah, that's actually my sister-in-law. She does that, and she's very sharp and does a great job. We did recently, just barely, like we've only done a little bit of it, but we just started working with a fractional reserve, like a fractional CFO. And so that's been kind of nice, just because I think we're doing a really good job, but we actually don't know if we are, right? Like what tells you how you're doing is when you turn everything into CPA, and we have very good CPAs, really happy with that group. And we get our K1s out mid-March so that our investors have everything in time for their, so I know we've got the right stuff and we're doing it, but like, I think we're just not quite there. So bringing on a CFO, again, that I don't have to pay 250 grand a year, but can just come in at an hourly rate and go, okay, well, where's your balance sheet? Where's your, what's trial balance? He's been talking about the trial balance lately, and I don't know what a trial balance is. So he's kind of working through some of that, because that's a big part of my, like, you got to get the numbers right. And again, like, I know we're tracking everything. I know we've got it all, but it's not as buttoned up as we'd like it to be. So that is one thing we're trying to make even better.
Yeah. Sure. Yeah. I mean, once you know your numbers really inside and out, then you can, affect the numbers, and you can drive them where you want them to go. Right. Because a lot of financial reporting is really just a history lesson. By the time you're reporting your P&L, it's too late to affect those numbers. Right. You're writing down what already happened. And so, but you do want to make sure whatever you're writing down is accurate and reflects what did happen. It can be a frustrating experience. But when you have in-house management, you're able to really control that process and get that speed and control, which, with third party is more difficult. Are there any other challenges with in-house, was there any like trigger event that occurred that was like, hey, we're going to move from third party to in-house? Like, what was the biggest challenge that you were experiencing with third party that you now aren't experiencing as much, or at least you have more control over?
I'll give you a couple of things. One was, I'll just give you a number, Michael. So they charge us a 4% property management fee. And so that's what a lot of people look, what's the fee? What's the fee? What's the fee? Well, but that fee, for one, it doesn't include payroll, and that's fine. We still keep payroll separate from our fee that we charge our properties. But that fee also doesn't include administrative costs and marketing costs. Now, marketing costs, you can kind of decide and control a little bit, but they always wanted to spend a lot on marketing because they made money on revenue, not expenses. So they wanted to spend a lot, right? And so that kind of gets to a point of contention. But their administrative costs just like run away. So I can tell you on one property, we worked with them for a full year, and I was able to kind of look back at the numbers, and I said, well, okay, you got your 4% property management fee, but if we add in administrative costs and marketing costs, what's that percentage? And it was 9.4%. So I'm like, man, that's really your fee. So what we ended up doing, when we took it in-house, we said, well, we're just going to charge the property a flat 7% fee. And that's going to be our management fee, marketing costs, administrative fee, everything. So, on $1 million, that's saving $24,000 a year on that, extra to 2.4%. So that's kind of one example on the numbers where like, it just kind of gets carried away because they don't have the same incentive. They're really not incentivized to control expenses. They're incentivized to maximize revenue. So that's good. And that gets into a little bit of like what was just really frustrating for me. And once I talked to a few guys here in town in Cincinnati that manage their own, I'm like, man, I want to play the game they're playing, because this property management company, again, they just drive revenue and they're really good at that, but they're not so good at controlling expenses. So if you're trying to sell, that's actually a pretty good strategy, because you're going to sell more based on your revenue than your NOI, in my opinion, in a lot of cases, because a lot of guys will look at it and they'll go, well, Lee's running it too expensive. That property management company is expensive. We can run it cheaper, right? But you really can't argue with revenue too much. It's like, I'm getting this rent. you're going to get this rent, right? Like, so the fact that they pushed rent so hard and did such a good job with that, the couple that we sold that they were managing, we did really well. And it didn't matter so much that they were really expensive because, they're kind of looking more at that top line. So, but on the other stuff that we didn't want to sell, it was really frustrating because they just pushed so hard. But one thing that I figured out that does, Michael, after working with them for a while, is like, you have a lot of turnover because they were really setting the market. Like, we had the highest rent in the market for our product type. And again, that feels great. And if you're going to sell, hey, that's great. But if you're not, man, we had a lot of turnover because the second someone couldn't make payments, like, you know what, I'm just going to stop paying because I know I can go across the street and rent for $100 less. And so there was just so much turnover. And again, that really doesn't hit them that much. That actually gets them another chance to fill a unit. And we didn't do like lease fees or anything like that, but they were bonusing their people that we were paying for. So I guess in essence they were, because they would bonus their people for filling units. So we were paying for that. And it just felt like, man, we were on this hamster wheel. And I'd go to talk to guys that were managing their own, and like they were not so worried about pushing rent so far. They would say, yeah, oh yeah, man, that property management company, they get higher rents than we get. But like, you just totally weren't worried about it because they were able to control their expenses and stay at high occupancy. Where like we would turn around and we'd be 88% occupied in a market. This is back in 2022 when everybody was 98% occupied. But it was just because so that was just really frustrating to me. And that's something that we've seen a difference on. Where like we can just chill out a little bit. We're not always trying to sell. We're not always trying to maximize the rent. We'd actually rather stay occupied and keep people in units and not have expensive turnover. And so that's something that was frustrating. And I was like I said, I want to play this game that these guys in town that are managing for itself that they're playing instead of this one. And I've seen that. Now times have gotten a little bit harder. And so we don't have the occupancy that I wish we had, but we're just not having to push so hard. And we definitely are controlling expenses better.
Sure. Yeah. Well, I think, you'd be even in a different position if you were trying to push revenue, then you'd be even a worse occupancy. So
and I know people that are still working with them and they're in that situation for sure.
Right. It's asking rent is not, effective rent, right? You got to actually get the rent that you're 100%. Charging. So, that echoes a lot of what I've heard from folks about going from third party to in-house. You've got that principal agent problem where, they have a different alignment, a different set of interests than you do, right? A little bit. It's not completely misaligned, but there are certain circumstances around that cost control, around the turnover issues. And again, to your point, turnover turns into commissions for them and maintenance and CapEx, right? So like they're turning the units, so they're getting paid on that. They're getting paid to release the unit. You could even argue that they're incentivized to see all your units turn every 2 years because that's built in additional revenue and things for the site staffs to do. And then the admin costs, and the marketing costs. We've had similar experiences. And it's not necessarily always that they know why they're spending the money on the marketing or that it's driving results, but it's aligning them right there, and they're going to spend it if they can. So because again, there's no cost to them to doing so. We're just about out of time here. So I'd love to before we say goodbye for now, You've done an amazing job building this business, vertically integrating over this last few years, building a nice portfolio, getting your investor base established. Where do you see this business going? Over the next 5-10 years, where do you want to be at in 2035 with Threefold with your company?
Yeah, Michael, I hope I'm doing all the same stuff. I would love to have more people working with me, more people inside, a lot more properties. The one thing I've done a terrible job of, I was, kind of explaining that we're okay with going more tertiary and going out and buy properties, but then we end up with this portfolio that's all spread out and we're not really getting the economies of scale. So if we can just kind of keep holding on and adding more, then we'll get more of that. And so we'll be able to operate even better. I'd like to, just have our property. We've just scratched the surface with building property management team. So, as we build a portfolio, I think that'll get much better. And so we'll be able to operate our properties even better, which that's, for me, that's all the property management company is. Like, we're going to be heavily invested and not necessarily always putting a ton of our capital in the properties because we're just not there at a point to be able to do that. But I still own a lot of the properties. And so we're heavily invested. And so if the properties do well, we'll do well. So the property management's just there to service that. And so I think we can do a better and better job of that and just keep building the portfolio. And personally, I would love, as we're able to build a team, I'll get to do just more of the stuff I really enjoy doing that I think I'm good at doing, and less of the stuff that I don't enjoy doing that I'm not good at doing. And so I'm really excited about that. So yeah, really just more of the same, just kind of become a more mature company, bigger company, better company. That's really the vision.
Awesome. Well, thank you, Lee. So with that, I just want to say, Lee, thank you so much for your time and for sharing some great insights and knowledge in the real estate space. If our listeners wanted to get in touch or find out more about the work you do with Threefold Real Estate Investing, how is the best way for them to get in touch?
Yeah, sure. We have a website. That'd be a great place to jump on. That's just Threefold, three spelled out and fold spelled out, and then REI is in real estate investing.com. So threefoldrei.com. And then I'm pretty active on LinkedIn. That's my favorite social media. So you can look up Lee Yoder on LinkedIn.
Great. Yeah, we will put all that in the show notes as well, so people can not have to write that down while they're driving or wherever they're listening or watching this. So great. Thank you for tuning into this episode of Deal Flow with me, Michael Pulio. Don't forget to give this podcast a follow on Apple Music and Spotify, and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something out of the show, please go ahead and send that across to them. Feel free to comment below with regards to future guests you'd like to see on the show, or get in touch should you think your experience and expertise would make for a great episode. Thanks again from me, and I'll see you next time on Deal Flow.